The sell in May, go away slogan, we think is a joke, frankly, except it has some merit if other factors are in place, like extreme valuations like we have right now, and the kind of economic backdrop and some of the technical signals of the market. We've talked in the last several months that we've had, even though we've been in a very overvalued market, the technical factors, momentum, and things like that have been tremendously strong. This has been a freight train kind of market. Hello, everybody. This is John Llodra. I'm a co-founder and partner here at New Harbor Financial Group, here for our weekly market update and video. Thanks for being with me here today. Purposes of this video and these videos are to provide data, our insight on that data, and really for the purpose of empowering and educating our clients and viewers so that they can live hopefully comfortable and stress-free financial lives. It's a tricky time out in the world and markets, and hopefully these videos can help. I'd like to remind folks to subscribe to our YouTube channel here. This is a way that you'll get alerted anytime we put new content out here. And feel free to comment in the comments to this video. Feedback is always welcome. If you have questions for us, please put them in there. We got to be careful. We can't respond to a lot of stuff given regulatory and compliance requirements, but we certainly can use that to inform future videos and reach out to folks directly or certainly invite you to reach out directly to us if you have questions. Want to encourage you to stick around for the entirety of this video. It's going to be short and sweet, hopefully, but I'll cover some big picture stuff. Then I'll get into some stuff in the right here and now, what's going on in markets and how we're seeing them. First, I want to remind folks or announce here that we're going on the road. New Harbor, here we are on the East Coast in Massachusetts. We have clients all over the country. We're very fortunate for that. We're going to go on a roadshow, a summit of sorts on the West Coast. On Thursday, May 16th, we're going to be in the Los Angeles area. And on Friday, May 17th, in the San Francisco area. We'd love to see our clients in those locations, but also folks who have come to know of us through this channel or other places that we appear. We really encourage you to come. It should be a great day. We're super excited to announce that Adam Taggart, our friend and longtime collaborator, founder of Thoughtful Money, be there in person with us, bringing his insight and perspective as well. And he's going to be interviewing another distinguished guest of ours, and that's the Jan van Eck, the CEO of Van Eck Investments. Van Eck is a pioneer in alternative real asset precious metals investing. The firm was founded in kind of the lead up to the inflationary crises of the 1970s. So their perspective and history, we think, is really relevant for the phase of the economic and market environment that we are now in. Their registration links for these events are in the bio to this video. You can also go to our web page at newharborfinancial.com and click on the events tab. There is an early bird registration deadline of May 2nd. The fee is $59 until then. After that, it increases to $79. So please, if you're in the area or want to hop on a plane or a car, come visit us. We'd love to see you. And we'll be visiting other cities most likely as the year takes on. So now back to the video here. The title of the video is one that you'll probably see plastered all over the media in the coming days. And it's because it's a often repeated slogan, the so-called sell in May and go away. This is something that Wall Street likes to throw around. It's catchy, it rhymes, and I'm going to kind of go over the basis for this, how it came to be, and whether it's really a signal that is something that you should follow. So it goes back several hundred years ago in the financial markets in London, I think, where literally the markets would more or less close for the summer, and the traders and financiers would take off to their country estates and whatnot. And even in more modern finance, it's often, talked about how the Wall Street crew heads out to the Hamptons for the summer. So it's generally a kind of a lighter time in markets that people are disengaged. And certainly we hope for our clients that the summer season is a time that they can unplug and go on vacation and really tune out. We're not going to the beach. Obviously we'll take some vacation as our individual schedules allow, but we're here. We're going to be watching the store, so to speak. So hopefully our clients can tune out a bit for the summer and enjoy some downtime. But getting back to the premise of this. So if you go back over the long history of financial markets, let's go back to 1945, for example. The average return in the May to October period is about 2%. That compares to an average of about 6.7% for the November through April period. So a pretty dramatic differential there between those periods. Now, I'm going to come right out and say we think slogans like this are really lazy, useless kind of signals. And they're lazy because they're basically a form of what we call analysis by averages. And we have a saying we like to say that analysis by averages leads to average analysis. And the reality is, like, you'll see all kinds of things pop up. And in fact, let me share an article here in a moment. But one area that we've seen this come up recently is, as there's been talk, not so much lately, but over the last several months, there's been talk about when and if the Fed is going to start to cut rates. And then, of course, there was all kinds of market takes as to what the stock market does when the Fed starts cutting rates. This is an article that appeared in the Financial Times some time ago. It shows the return in the stock market in the trading days before and after the last Fed hike. Not the Fed cut, but the last hike. In our case, here we are on Thursday, April 25th of 2024. The last Fed hike was in July of 2023. So there's been a long pause here. And the question is when the cut will come. But what you see here is an average return in the market over, say 50, 100 days, 150 days, 250, whatnot, after the last hike. And that looks all well and good, and one might use that and make some conclusions. But if you look at the actual range of outcomes around that average, it's an impossibly wide range. That's just an example of how average analysis totally misses the context underneath the surface. So you'll see oftentimes pieces out there that say, hey, if when the market is up X% or more in January, 9.5 times out of 10, 95% of the time, it's going to be positive for the year. So it says, okay, well, that's pretty good odds, right? There's only a 5% chance. What this that the market won't be up on the year. But what this completely misses is the notion of what's called conditional probability. That 5% in that hypothetical example I just talked about there may actually be a very high incidence occurrence when certain other factors hold, like when valuations are above a certain level. In fact, getting to that example of what happens to markets when the Fed cuts, you can look back and say when valuations are very extreme, actually when the Fed cuts rates, the markets actually on average lose a ton of value. And you look at the last major bubbles, the tech bubble and the housing bubble, that's exactly what happened. Valuations were extremely high, bubble valuations, which we would say apply to here today. So we think actually when the Fed cuts, it's probably going to be in the context of market dropping. This is a snapshot of the 20 worst days in the S&P 500 going back to 1950. And you can see the worst day was in October of 1987, down over 20% on a given day. What you see here is amongst these 20 worst days, all the ones in red are the ones that occurred in this May to October period. So there is a very sound historical basis for this period to have within its time frame some very nasty periods. A lot of the big October events and even some of the summer events. There are plenty of years where that hasn't happened. So there's something else going on here, and that's why I think valuations are a key point of the puzzle. 2008 we saw very highly represented on that 20 worst days. Look where valuations were. This is the tech bubble. Here we are. This is Shiller PE ratio. We're at levels that are near all-time highs, and if you adjust this for profit margins, we're literally at all-time highs. The sell and may go away slogan we think is a joke, frankly, except it has some merit if other factors are in place, like extreme valuations like we have right now, and the kind of economic backdrop and some of the technical signals of the market. We've talked in the last several months that we've had, even though we've been in a very overvalued market, the technical factors, momentum and things like that have been tremendously strong. This has been a freight train kind of market that has been broadening somewhat in its breadth, which is a kind of a healthy, not a healthy thing, but a reinforcing thing for a strong momentum-led market. All right, this is a daily chart of the S&P 500. Each one of these candlesticks here is a day. And what you have here, this fuchsia line is the 50-day exponential moving average, and this orange one is the 20-day exponential moving average. What you saw here off the peaks of the end of March, we've had a pretty sharp pullback here, over 5%, about 5.25 and change, I think, to that low just a handful of days ago. So we took out that 50-day moving average, which is one just very simple technical signal that's not a healthy thing. But we very quickly rebounded here and poked above it. And so far, that poke above that 50-day hasn't held. It's pulled back. And here today, we're having some downward action in the market. We had a big miss by Meta, Facebook, in the after hours last night on earnings, and stock sold off really hard. So we had a weak market, but it's actually rallied up on the day. It's off the lows, but still down quite a bit. So this is just one kind of technical signal that isn't entirely encouraging. Combine that with really overvalued metrics like the CAPE ratio, and we have the recipe for a May to October period that could end up being rather challenging. But there's so many other indicators you want to look at. We would not make an assessment based upon this alone. But this is the percentage of S&P 500 stocks that are on a bullish trend. And this is a point and figure chart. And you can see just recently we reversed down from above about 76%. That is one more checkbox in the camp of perhaps raising some caution here that this market rally is running out of steam, and we may see some further downside. I'll call out the last couple times this did this. You go back to right here. This is January of 2022. That's right before the market was down tremendously for the first 10 months or so in 2022. And then we had another one in July of last year when the market hit the skids pretty hard into October of last year. This is just one of several other indicators we follow. This one happens to be ticking a little bit more on the cautious category. So we're watching this and other indicators we follow very closely here to see if we get confirmation that this really could be more than just a short-term pullback and a follow through to the downside. We're very comfortable with how we're positioned. We have a lot of hedges in place for the equity exposure that we do have for clients. But again, we'll watch things very closely and make changes accordingly. To the news of the day, so one of the reasons the markets are selling off today, not just the Meta earnings after hours, but today we had a couple of things, a couple of doozies here. First of all, the PCE, preferred inflation indicator by the Fed, that's watched by the Fed, came in much hotter than expected, 3.7% versus 3.4%. So we're getting another data point here that inflation is perhaps sticky and maybe even turning up. At the same time, the GDP report came in quite a bit softer than expected. So this harkens back to the 1970s in a period that was defined by stagflation. What is stagflation? It's a period of persistent and rising inflation at the same time of low growth and things like rising joblessness. It's a particularly nasty kind of economic scenario for people on everyday Main Street, of course. So we very well could be looking at that kind of scenario. The odds of a Fed rate drop this year have dropped tremendously. Looks like they're even talking about possibly hiking. So these are things that markets haven't priced in and could be fuel for further downside. But again, we're watching our battery of indicators. Not quite ready to say that this recent pullback is going to cascade into something larger, but there are some things falling into place that would give an increasing probability of that. So back to the sell in May and go away. And this is really the call to action, I think, for folks. Again, I think that slogan is lazy. There are times in the May to October period where absolutely you should be invested and markets can do actually remarkably well. But when you get situations like we have now with high valuations and a somewhat murky technical and somewhat deteriorating technical picture, it absolutely, I think, is good reason to take a step back and review your risk exposure, lighten up on equities if you're more exposed than you think you should be. Consult your financial advisor if you're not with us, of course, and we invite viewers that aren't clients of ours to reach out to us for an objective review. But it's a time to bring it back to your own personal situation and know that we are really skiing, out of our skis, so to speak, in terms of the market advance over since last October. We're due for a rather large correction at some point, and this may in fact be the very start of that. More to come on that as markets and data comes in, but just urge you to kind of take a look at your situation and take decisive action. So I guess just in wrapping up, again, I want to remind folks to come see us in person in LA area on Thursday, May 16th, and in the San Francisco area, Friday, May 17th. The links are in our bio here and on our website, newharborfinancial.com/events. And I want to thank you for watching. And until next time, I wish you a great day.